pertinent to year-end planning. So that's okay.
Okay.
Uh,
Okay.
See that we were recording, so I'll go ahead and start. Hi, everyone. My name's Tony Watson. I am here on behalf of Robert Hull and Associates, bringing you the topic of year-end tax planning. Some of the major moves that you can make towards the end of this calendar year that hopefully will result in major tax savings. So as people start to log in right now, we'll go ahead and get started through the first couple slides here. Once again, my name is Tony Watson. I've been working as a tax advisor in Glendale, California, Southern California for the past actually 16 plus years. I prepare anything from individual to business tax filings with the US government as well as the state of California. We are an award-winning practice, as well as my title here, aside from preparing taxes, I am also the keynote speaker, speaking at over 100 plus events on a year-to-year basis. Make no mistake, 2020 has been a very unique year for a number of reasons, but that's what's bringing us to you on this digital platform. I think that the volume, let me go ahead and mute that one. And so just so that it's not disturbing the event here. Obviously 2020 has been a very unique year. So I've adopted the characteristic more than ever this year of patience. It's been a year that has tested all of us in more than just a couple of ways. But nonetheless, as we approach the end of the year, the importance of tax planning remains one and the same as other or previous years that we've gone ahead and filed taxes in. So just be aware that as we approach the end of the year, the main goal for you as a real estate investor, as a small business owner, is to contact a licensed tax advisor and map out a strategy before the end of this calendar year, December 31st. By no means am I a one-man operation. I am actually backed and supported by some of the greater senior staff accountants in the Southern California area, if not in the US. We service tax filings in all 50 states. So naturally, it couldn't only be me filing the 15,000 tax returns that we process on a year-to-year basis. But I just want to mention that if you have investments outside of California, we are readily available to answer any of those questions that you may have about revenue code across the US. So jumping right into the importance of year-end planning, why do you individually think that year-end planning would bring a benefit to you personally in your financial world? Well, when I ask people this, usually there are three answers that I get. One is to avoid any unnecessary penalties and interest. Two would be to position yourself for greater tax benefits, so allowing yourself to capture more deductions before the end of the calendar year. And some will say just for simple peace of mind, Tony, I want to know what my tax return looks like before the year is even over, right? I mean, some of us may wish that we could tell the future, others may not, but if we could tell our financial future so that we could position ourselves earlier enough in our life to set ourselves up, not for failure, but for success, why would we not take that approach, right? So year-end planning is actually a little bit of giving you the power of being able to see the future. It's being able to tell what exactly your liability is before the end of the year is even here. So once again, whether it's for avoiding penalties and interest, or for positioning yourself for greater tax benefit, or even for just simple peace of mind, it could be all three, in fact. Nonetheless, all three are appropriate answers. The year-end planning appointment that you'll have with your tax advisor is meant to achieve all three of these goals. And so just remember that as you approach the end of the year, yes, tax season is right around the corner, and I'd much rather us know ahead of time what the overall obligation is just by putting a plan in place. In every in-person seminar and every webinar that I've given this year, I've always mentioned that this phrase in particular goes hand in hand with the tax industry in more than just a couple ways. Failing to plan is ultimately planning to fail. And so year-end planning is meant to set you up for success, meant to set you up for you to know the results before they actually happen. And so just understand that the review at the end of the year is probably even more important than the actual tax appointment itself. Now, we call our year-end consultations W-4 reviews, and the W-4 review is very different for employees versus real estate investors or self-employed individuals. The W-4 review for an employee is very straightforward. Basically, it's a review of your pay stub. It's to figure out what you've made year to date in taxable income, what you've paid into the system as far as federal and state taxes are concerned, and to figure out essentially if you're on track to underpay or overpay the federal government or the state of California. A W-4 review for a self-employed individual is a little different. We do review year to date income and year to date expenses, But because you haven't actually prepaid any tax normally, if you're self-employed or if you're a real estate investor, we need to figure out what amount we should be prepaying before the end of the fourth quarter to avoid any penalties and interest. And it's not just a number that we as accountants make up for you. It's actually a very calculated figure that we need to come up with. In order to avoid penalties and interest completely, the federal government requires you to prepay either 90% of the current year liability or 110% of the previous year's liability, whichever is greater. And so the federal government actually does require you to prepay a certain amount of tax if you are trying to avoid penalties and interest. I can tell you right now, some people don't prepay their tax. And it's mainly because as investors like myself, I'm a real estate investor. I own small businesses. My wife is a real estate investor. She owns small businesses. So collectively, we have a lot going on. And because of the amount of opportunities that I find myself approached with throughout the year, me personally, I'd rather keep my cash liquid up until the very, very last minute, which happens to be January 15th. Now, I could wait until April 15th to actually pay my tax, but remember, April 15th is not a payment deadline. April 15th is only a filing deadline. Same with October 15th, the extension deadline. Those are only deadlines for you to file the return, not for you to prepay tax. So in order to avoid penalties and interest, I hold my money right up until January 15th. And let's say that I'm not flush with cash right now. Let's say I have my money parked in all sorts of different investments. Yes, at that point, I may actually keep my cash until April 15th or October 15th, knowing fully well that there's a penalty or interest that I'll have to pay. But as long as my ROI, my return on my own investments is greater than the potential penalties and interest assessed, I figured that was a good financial move for me personally. Once again, not all of my clients want to play that game, but this is an option for you as a real estate investor or real estate professionals for you to keep your money for a longer period of time, as long as, and this makes sense only as long as your own individual investments are returning you a greater percent in profit than what you potentially are going to be assessed in penalties and interest come filing time. So understand that that is very much a game that you can play. It's playing it very close to the chest. It's very easy for me to do this personally because I have all of my tax calculators at my fingertips. But you should feel the same way. It's just you need to be more in contact with your tax advisor if you do want to play this potential game with all of your revenue. So just keep that in mind. April 15th and October 15th, only filing deadlines, not deadlines to pay your tax. January 15th, the end of the fourth quarter, is actually the date where you need to cover either 90% of your current year liability or 110% of the previous year's liability, whichever is greater. And this is obviously to avoid any additional assessments. So once again, whether you're an employee or a self-employed individual, the importance of year-end planning is one and the same, but the approach is a little bit different. One, you've already prepaid a lot of your tax. The other, you haven't really prepaid very much of anything. And so at that point, I'd say that year-end planning for a self-employed individual is much more important than a W-2 year-end planning appointment with an employee. So keep that in mind. Now, as far as deductions are concerned, as we approach the end of the year, sure, it's important to do year-end planning and whatnot. But on top of all of that, what are some deductions that we can invest our money into right before the end of the year to really retain more of the hard-earned revenue that we've built for ourselves over the course of the last 12 months? Well, understand that all of the deductions I'm giving you today, the top 5, these are only the top 5. I mean, there are hundreds, if not thousands, of deductions that you could potentially come up with, but these happen to be the most common write-offs for a self-employed real estate professional and or a small business owner or rental property investor. Number 1, marketing and advertising. Think about this. When you have a vacancy in a rental property, when you are trying to build business for yourself, you need to market or advertise your business. By the way, for individuals who are just logging in, we are recording this webinar. We had a little bit of technical difficulty this morning, but the pre-recorded webinar will be available for you after this time frame. So if for some reason at the end of the hour you have to jump off, don't worry, this information will be pre-recorded for you. So marketing and advertising, a great dollar for dollar overall write-off. And let's face it, how do you build business? How do you make sure that you have very few vacancies in your rental properties without marketing yourself, without promoting your business? And so the government knows this. The government is going to allow you a dollar for dollar deduction against income for marketing and advertising expenses. Now, when I say dollar for dollar deduction, this does not mean that this is dollar for dollar added to your refund or dollar for dollar reducing your liability. This means that if you made $50,000 and you spent $10,000 on marketing, that you only pay tax on $40,000 that's left over. So you avoid paying income tax on whatever dollar for dollar deduction you're able to take. And so one other reason that you need to have a licensed tax advisor, aside from actually preparing the return, is to have somebody to find as many dollar for dollar deductions that are ordinary, necessary, and legitimate under current Internal Revenue Code for you to take to offset your taxable income. Remember that we all have an obligation in tax to pay the government, but through proper planning, we can pay our obligation in tax and not a penny more than that obligated amount. So keep that in mind as we approach the year end. It's very important for you to sit down and map out all of your expenses to figure out, hey, am I going to overpay the government? Am I going to underpay the government? Hopefully you're on track to breaking even. That really means that you didn't overpay, you didn't underpay, and therefore you paid exactly what your obligation in tax was and not a penny more than that obligated amount. And the way that you get to that number is by figuring or calculating as many dollar for dollar write-offs for yourself as possible, or finding as many dollar for dollar write-offs as possible. So marketing and advertising, great overall deduction, dollar for dollar. Professional supplies and equipment, you have options of how to write this off. You can either accelerate an equipment or a furniture or a supply deduction and take it all in 1 year as an expense, or you can spread the deduction out over its lifespan. So what the heck does that mean, Tony? Well, if you go out and you buy a desk, for instance, for your office, in-home office, because a lot of people are working from home now. If you go out and you buy a desk, the desk can either be taken fully in 1 year as a write-off, or it can be spread out over 5 years, which furniture has a 5-year lifespan, depreciable lifespan. Now, your question to me is, well, Tony, why would I ever not want to take it all in 1 year? Why would I want to lose the deduction and just spread it out over the next 5 years? Well, let's face it. Let's say that in 2020, because of the pandemic, let's say that you just made enough revenue to equal your expenses. So at this point, let's assume that you're already not paying any tax. Why would you take all of the deductions in a year where you're already not paying any tax, right? The option of spreading it out over the next 5 years may be a better option because let's say 1 or 2 years down the line, the pandemic dust has settled and now we're back to whatever the new norm will be after the pandemic, comes to a halt, or whenever it gets, is controlled a little bit more. At that point, you may need the write-off. So 1 or 2 years down the line, let's say that, okay, my revenue is back up to showing a pretty nice profit. Well, now I have this deduction readily available to capture the remaining depreciation of the expense and take it all in that year. So equipment and furniture are great accelerated write-offs, or you're allowed to depreciate them over the lifespan of the asset. A computer, a piece of equipment, for instance, has a 7-year lifespan. Furniture has a 5-year lifespan. Cars have 5-year lifespans. Property can range anywhere from 27 and a half years to upwards of 39 years, depending on if it's residential or commercial. So understand that there are depreciable lifespans to assets, and some assets you may be able to accelerate and take it all in 1 year or spread out over the lifespan of the asset. Also, professional supplies and equipment has one of the lowest risks for audit. I mean, think about this for a second. Take a step back and think about how many people you know in your own world, in your financial world, in your business world, who can do business without a computer. How many people do you know who can do business without a cell phone or without internet, right? These are some of the most common deductions because they are almost they're necessary expenses, necessary things for you to operate your business. And so therefore the government knows that this is a necessity for your business in today's day and age. And so therefore it has a very, very low risk for audit. I love professional supplies and equipment. I think that you should absolutely maximize that deduction at every angle possible. Car and truck expenses. This probably is a webinar just in itself. So I'm going to try to dial it into maybe a 5-minute conversation here. Car and truck expenses. If you are not in the business, or if you're not in the market to either lease a new car or purchase a new car, then you're looking at either the mileage deduction or the actual car expense deduction. 98% of taxpayers will end up taking mileage for a number of reasons. Mileage tends to be a much higher write-off, a much larger deduction than actual car expenses. And also it has a lower risk for audit. Because on mileage, the way that you prove it, if it is ever questioned in an audit, is with your own notes. It's with a mileage log. And the government, in 17 years that I've worked in the tax industry, I've yet to see an audit where they've denied the mileage write-off. Now, have I seen the IRS try to limit mileage? Sure. They try to limit a lot of things through an audit, but at the end of the day, they've never disallowed the mileage deduction. So one, it has a very low risk for audit. Number two, it tends to be a much larger write-off than the actual car expenses. See, mileage overall is broken down into three sections: personal, commuting, and business. Now, personal and commuting mileage, not tax deductible, but your business mileage is deducted at 55 cents per business mile. Well, let's face it, if you put 10,000 business miles on your car, that gives you a $5,500 tax write-off. Well, in order for actual car expenses to be greater than that, you're looking at multiple tire changes, multiple oil changes, maybe even an engine repair, or having to replace a whole engine that insurance will not cover. And at that point, you're looking at some very unique situations where actual auto expenses may be a greater tax benefit than mileage. So understand that mileage will always probably be your go-to actual, car deduction, unless once again, you are in the market to either lease or purchase a new car. So the probably the most common question about car and truck expenses for me as a tax advisor is when clients come to me and say, hey, I need a new car. Is it better for me to lease or is it better for me to purchase? Well, it's not really a loaded question. It just means that we have to dive into a more in-depth analysis as to what will benefit you more. I personally believe, and this is just a personal opinion of mine, we don't have to share the same beliefs in this, but personally, not professionally, personally, I think that leasing a vehicle is more of a lifestyle choice. You're actually renting someone else's asset. You're not paying into anything that you will eventually own at the end of the day. So just understand that when you lease a vehicle, let's say it's your only vehicle that you own, you still have to allocate what business use is versus personal use. Real estate professionals, whether you're a property owner or a real estate commission, self-employed individual, real estate professional, selling property, making commission income, leasing is always going to be heavier on the business side than the personal side. So you're still going to look at a 65 to 70% write-off for your lease expense, 30 to 35% allocated for personal use. Now, leasing is also a much lower, more consistent write-off. It's a small deduction, maybe at $200, $300, $400 a month, unless you're leasing a Range Rover, which could be $1,000 to $1,500 a month, right? They're very expensive vehicles. So at the end of the day, it's you paying into something that you don't own, but it is a low, very consistent write-off. And it does allow you to trade in the vehicle after 2 years for a brand new vehicle, drop it off if there's ever any trouble with the engine or the brakes or anything. You don't have to really come out of pocket for all of that. So people will choose leasing more for a personal use, side of things, because they don't want to deal with the hassle of car ownership. However, leasing does not give you or return you the same tax benefit that purchasing a car will return you in the first year of ownership. See, as of 2018, the federal government brought back something into the Internal Revenue Code called bonus depreciation. This means that if you go out and you buy a vehicle, and it all depends on the weight class of the vehicle, okay? If you go out and you purchase a vehicle and it weighs under 6,000 pounds, you get a first year write-off of $18,000. That's your upfront depreciation deduction. And then the remaining value of the vehicle is depreciated over the following 5 years, because a car has a 5-year lifespan. So sure, $18,000 deduction in the first year, that sounds great. And the remaining value spread out over the next 5 years. That's if the vehicle is under 6,000 pounds. What happens if the vehicle is over 6,000 pounds? This is where the magic really happens, because the federal government, once again, as of 2018, brought back something called bonus depreciation. But if it weighs over 6,000 pounds, it is 100% bonus depreciation, which allows you to fully deduct the 6,000 pound vehicle against all self-employed income. Meaning that if you go out and you buy this $60,000 Chevy Tahoe and you use it solely for business, this 6,000 pound vehicle is 100% tax deductible on your federal tax return. That returns you a $60,000 write-off. Now, if you're self-employed, and let's say that you're paying $60,000 or you have $60,000 in profit, that is a dollar for dollar deduction. $60,000 in revenue offset by a $60,000 write-off. Now you're at a zero balance. You're not paying any tax. So right before the tail end of the year, you're going to see a lot of your fellow colleagues, probably per the advice of a tax advisor, who were already looking or in the market for a car. You're going to see them going out and purchasing 6,000 pound vehicles, because once again, they were already looking to buy it. So why not capture it in a year where you also receive a major tax benefit for this purchase? Once again, it's a whole hour to 2 hour webinar just in itself, the purchasing versus leasing topic, I would say. So if you have specific questions about this, feel free to reach out to our office. We can map out the actual ROI for you on this specific deduction. ROI stands for return on investment, for those of you who don't know what ROI stands for, but we need to make sure that the car investment itself makes sense financially. I am not going to send people out to buy cars just to buy cars, right? It's still at the end of the day a depreciating asset. I'd much rather you park your money in real estate. But at the end of the day, if you're already looking to buy a new car, why not capture that as a very, very sizable tax write-off before the end of the calendar year? So keep that in mind. Legal and professional fees, dollar for dollar tax deductible in most cases. However, if you are a W-2 wage earner, like if you're an employee and you also have self-employed income, legal and professional fees will not offset any of your W-2 income. As of 2018, a majority of employee expenses went away. In fact, employees as of 2018, not self-employed individuals, but employees are only allowed to deduct mortgage interest and property taxes and charity. And that all depends on how much that is, because if it's less, if you add up all of those expenses and it's less than the standard deduction is, then yeah, they won't even be a tax write-off. So fast forward to 2018, employees are no longer allowed these write-offs, but self-employed individuals still are. Okay, so if you're self-employed or if you have rental investments, legal and professional fees still a great dollar for dollar overall tax deduction. Okay, now property deductions. Let's dive into a little bit more detail about property write-offs, because we really need to divide property deductions into two sections, right? Or two divisions: the primary residence and the rental investment. Remember, on the primary residence, you're really only allowed mortgage interest and property taxes as write-offs. Property taxes and state income tax capped at $10,000. So state and local taxes, called the SALT deduction, are capped at $10,000 total. That's for your primary residence and a second home. If you rent out a property, a different story, but we'll get to that in a second. So on the primary residence, it's property taxes capped at 10K, and also number two, mortgage interest. Now, as of 2018, if you bought a home after that date, if you bought a home after December 15th of 2017, you are only allowed a portion of your interest deduction as a write-off. And that all depends on how much debt is attached to the property. So before the new tax bill passed in 2018, we were all allowed an interest deduction on the first $1 million of acquisition debt on a primary residence and a second home. Fast forward to 2018, that limit dropped from $1 million down to $750,000. And this is per property. This isn't total amongst the primary and the second home. It is $750,000 per property. Okay, so interest and property tax is still a great overall write-off for a primary residence. What happens when you take that home and you rent it out, though? See, when you rent out a property, there are no limits to your mortgage interest deduction. There are no limits to your property tax write-offs. So just be understanding that with a rental investment, it is very much a business. So therefore, it sees less restrictions as to, or limitations as to what you can fully deduct against rental property income. So keep that in mind. The tax sheltering benefit through rental properties will still be available, whether it's the old tax bill, the current tax bill, or any future tax bill. Rental investments and their deductions will be one and the same. Let's face it, rental investments, property acquisition, property sales, those are the true stimulators of the U.S. economy. So I don't foresee the federal government, even under a Biden tax administration, I don't see the federal government taking away any rental property related tax benefits. They might phase you out from certain benefits if your income is above $1 million or $2 million, because they don't want the 1% of the world to really receive this benefit. But we'll have to wait and see what the future tax code has in store for us. Just be aware that you need to understand the differences between a primary residence write-off versus a rental property investment write-off. Now, as we approach the end of the year, another topic will come into play, and that is the topic of retirement planning. So understand that up until about 1974, the federal government required all of us to invest our retirement income into the stock market. That was up until about 1974. As of 1974, the game has changed a little bit. The federal government actually now allows us to invest our retirement income in real estate related activities like real estate syndications, buying and flipping, buying and holding investments, buying small businesses. So you are very much able or allowed since 1974 the ability to invest your money in things such as real estate investment vehicles. But once again, it has to be under your retirement plan. So whether you have a traditional IRA or a traditional 401k versus a Roth IRA or a Roth 401k, the investment will be a little different because obviously the traditional side of retirement is deferring the tax on all of your money, whereas the Roth retirement account is actually paying the tax up front, and then the growth from here on forward until you retire, that is then tax-free. So have this conversation with a tax advisor to figure out whether or not a traditional type self-directed retirement plan works for you versus a Roth, a self-directed Roth retirement plan. They're very unique investments. Once again, this is probably a whole 2-hour webinar just in itself as well. But as we approach the end of the year, I'm trying to cover all of the little intricate parts of the Internal Revenue Code that really benefit you towards the end of the year for year-end planning. So once again, you have options, and this has been around since 1974. So don't think that you've missed out on anything. This is still very much a benefit for you. And if you haven't exercised this benefit over the last 10, 15, 20 plus years, then maybe it's time for you to sit down and map out a plan with your own tax advisor, with your own wealth manager, to have a more diversified retirement portfolio, right? Why not have a little bit of everything? Why not have the stock investments as well as the real estate investments or syndication investments? Have a conversation with your wealth manager as well as your tax advisor to figure out what the best avenue is for you specifically. Also, remember that everyone's tax return is different. Therefore, everyone's tax advice will be different. It's it's not fair for an accountant to give very general answers and say that it applies to everyone, right? In a webinar, I did a webinar yesterday where there were 450 people logged in. I do webinars where there's only 5 to 10 people logged in. So I have to be very not vague with my descriptions or my teaching positions, but I need everybody to understand that the advice that I give in my webinars, it might be different or custom tailored for everyone individually, because all of your tax returns are different. Just because the new tax bill benefited your neighbor or your coworker or your family member, a friend, doesn't matter, because that's their tax return. It benefited them in that way. Now, we can maximize benefits for you, but it will be in different ways. No two tax returns look alike. Okay. Unless you're married filing joint, then there's only one tax return. And yes, you and your spouse have pretty much the same tax return. Okay. So just be aware of that. As you approach the end of the year, the conversation of entity selection might pop up as well. Do we incorporate ourselves as LLCs? Do we incorporate ourselves as S Corps? Why would we want one over the other? Is there a tax benefit to any of this? Well, let's talk about the LLC first. LLC stands for Limited Liability Company, as seen on your screen. And LLCs are not tax savings entities. LLCs are strictly, solely, and mostly for protecting large assets. So therefore, LLCs are best used to protect large rental investments. Actually, not large rental investments, any type of rental investment, if you have any sort of a high level of risk or liability. And let's face it, at the end of the day, the true asset in a rental investment overall is your tenant. Sure, the building is an asset, the land is an asset, having that cash flowing business is an asset. But what is a business without revenue, right? It's just a losing business. And without a tenant, your property is actually just going to lose you money. I mean, sure, it'll appreciate over time, but at the end of the day, when you have a rental investment, it means nothing unless you actually have somebody living in the property, right? So when you have an LLC, it's really meant to separate your business and your personal assets completely from each other, meaning that you want your personal assets held individually with their own custom tailored insurance policies for protection. And then you want your rental investments separated from all of your personal liability into their own limited liability companies. Now, whether or not you specifically need an LLC is a different story. I'm being very vague about what to use LLCs for. So this is also a conversation you need to have with not only your tax advisor, but probably with an attorney as well. Because there is no tax benefit to an LLC, there really is only legal benefit. So the only benefit that you get is on the legal side. And that's where you talk with an attorney. Okay. So the attorney is going to tell you all about the legal benefits of an LLC. A tax advisor is going to say, great, that's great for asset protection, but an LLC will not save you any tax. Whether you're self-employed, own rental properties, you share a business with a partner, an LLC will save you nothing in tax. Now, for the rental property owners, LLCs are best for rental investments. I want you to kind of take that with you from this webinar. You only would really like to use LLCs to protect rental investments under. If you are a self-employed real estate professional, if you're a realtor that sells property for commission income, Yes, an LLC would allow separation and protection of that business, but because it provides you no tax benefit as a self-employed individual, you may want to set up the LLC, but then immediately convert the LLC into a subchapter S corporation. And the reason why an S corporation is best for a self-employed business, not a rental property, is because the S corporation actually will end up saving you tax. Now, it does not save you federal tax and it does not save you state income tax. But what an S corporation will help you achieve is a significant reduction in overall self-employment tax. Now, remember, rental properties do not pay self-employment tax. That's why rental properties are best under LLCs. There really would be no tax benefit at all, whether you had a rental property in an LLC or an S corporation. But if you are a self-employed real estate professional, it's a different story because rental income only pays federal and state income tax. Self-employed income pays federal, state, and self-employment tax. And that self-employment tax is the tax that an S corporation will help you reduce. For those of you who are self-employed and know about self-employed tax rates, shoot, federal and state income tax is a variable rate. Self-employment tax right out the gate alone is 15.3% of your company's profit, of your self-employed net profit. Well, 15.3%, that's a lot. I mean, let's say that you're in the 22% federal bracket, 9.3% state, you're already at 31% tax paid. Then add 15.3% onto that. I mean, shoot, you're at what, 41, 46, 47% in tax overall. So why would you not, if the numbers made sense, okay, and I can tell you right now that at about $40,000 to $45,000 in self-employed net profit, that's when an S corporation would actually save you more than it costs you. Why would you not take that next step to reduce your self-employment tax by upwards of 60%? So how the heck does an S corporation achieve this? How does an S corporation actually help me reduce Social Security and Medicare tax? Well, let's let the numbers explain for themselves, okay? Let's assume that you are a real estate salesperson, right? You're a realtor that sells property for commission income. And let's say that after all of your expenses, you're able to get your company's profit, your commission income down to $100,000. Now, as a sole proprietor, as a person who is not incorporated, or even if you're set up as an LLC, remember LLCs and sole proprietors, they pay tax the same. There is no tax benefit to having an LLC. So let's assume, just for numbers' sake, that you're at $100,000 of net profit. As an LLC or as a sole proprietor, you pay federal, state, and self-employment tax on the full $100,000. If you flip this sole proprietorship or an LLC into an S corporation, the profit remains the same, right? In this scenario, it remains $100,000. But now, because you are set up as an S corporation, you technically are no longer considered to be self-employed. You actually are required to be an employee of your own corporation. Excuse me, my throat's a little dry. So understand that because you are no longer self-employed, you are required to put yourself on payroll through your own corporation. And if you're on payroll, if you're an employee of your company, you have to receive W-2. And this is where the magic actually happens. You are actually achieving the tax savings benefit by paying yourself a reasonable salary. Now, here's the kicker. Under a corporation as a real estate professional, you are only required to pay yourself a minimum salary of at least and no lower and no higher than 40% of your company's net profit. Well, 40% of $100,000 is $40,000. That's your W-2. Now you get to write yourself off. You actually get to deduct what you paid yourself as an employee. So 100,000 minus 40,000 gives you a company profit, leftover profit of $60,000. Now remember that as a sole proprietor or an LLC, you're paying self-employment tax on the full 100,000. Now in this scenario, because you're no longer self-employed, you don't pay self-employment tax anymore. You pay payroll tax, which is Social Security, Medicare. They're the same thing. It's just as a self-employed individual, non-incorporated business owner, you pay Social Security as self-employment tax on the full $100,000. If you are incorporated, you now pay payroll tax, and payroll tax is only paid on the $40,000 of W-2 income you paid yourself. So on the $60,000 that's left over in this scenario, you have properly avoided, not evaded. Remember, tax evasion is illegal. Proper tax avoidance is not. And so you are now avoiding paying 15.3% of Social Security and Medicare tax on $60,000. All right. That roughly comes out to be about $9,180 in overall tax savings. So just be aware that, I mean, this is a huge benefit, but only if the numbers make sense. Your net revenue has to be at least $40,000 to $45,000, not $100,000, but your net profit has to be at least $40,000 to $45,000 in order for an S corporation to save you more than it's costing you. Now, the power of Inc. is a whole conversation to be had individually with a preparer, but it's also a whole a webinar just in itself. In fact, I do a 1-hour webinar on the power of Inc. And so there's a lot more in-depth analysis that needs to be made if you are taking that next step to incorporate. But shoot, if I've turned on a light for you, if I've lit a candle in this dark room of the tax code for you, and you're thinking, well, I've been way above $40,000 to $45,000 in self-employed income each year, I wonder why my tax advisor has never suggested for me to incorporate. Well, I can't speak on their behalf, but sometimes other tax advisors don't understand how to operate corporations from a tax perspective. Some might fear that a corporation will increase your risk for audit, which is actually the exact opposite of what it does. And to be real honest with you, maybe your accountant, I'm not saying that they are, but maybe it's an accountant that is a little bit lazy, that doesn't want more paperwork to do your tax return. They're very set in their ways. They want to do the individual tax filing and that's it. And they charge you for that. But let's face it, over the last 10, 15, 20 plus years, so the S corporations have been around since the early 1970s. Okay, so this has been an option for you for a very long time. At this point, over the past 17 years, I've probably filed 4,000 or 5,000 plus S corporations just by myself. That doesn't include all of the thousands of additional S corps that are firm files on a year-to-year basis. So I'm talking about over a 17-year period, I filed that many. And I understand the S corporation and how it saves you tax. Same with all of our other senior advisors here. We know that corporate America benefits not only the 1%, but it can also benefit the lower income businesses all the way down to a net profit of roughly about 40 to 45,000. So if you want to hop into a calculation conversation with a tax advisor, utilize our free consultation. I'll give you my contact information in a couple slides here. Utilize Robert Hull & Associates and ask us to make this calculation for you, to figure out if incorporating is actually going to result in a financial benefit in your specific situation. Once again, incorporating is not right for everyone. Just because your neighbor or your coworker or your friend or family member incorporated their business, it doesn't necessarily mean that you should also incorporate your business. So keep that in mind, okay? Very, very important to understand. Now, a couple things that have changed over the past 10 months since the pandemic really started to set in. At the IRS level, the IRS laid off hundreds, if not not hundreds, thousands of their employees. As a result of the pandemic, with the IRS layoffs being a result of the pandemic, we've seen longer processing times. We've seen erroneous letters being sent out. We've seen incorrect assessments, lender-borrower complications. We've seen everything. The IRS roughly right now is about 8 to 10 months behind in their processes. That equates to about 3 million documents that still are needing processing and about 1 million tax returns that have not fully processed yet. I have clients who filed amended returns last October and they still have not processed with the IRS. So understand everything is still very much in this pipeline. Just understand also that because of the pandemic, there are a lot of errors and mistakes made at all levels of government. And I'm not going to say that it's fully their fault because nobody predicted that this would ever happen. Nobody ever foresaw the pandemic being as heavy as it has been weighing on the US economy, but it has changed a lot of the government processes and they are really, really trying to catch up with everything. So once again, I've very much adopted, I've been patient in the past, but I've had to learn to be more patient because of COVID-19 and because of the pandemic. So just understand that it's not your duty to be in contact with the IRS. It's your tax advisor's duty to do this. So if you do not have a tax advisor who reaches out to the IRS on your behalf, you need to start working with a tax firm that actually does and handles a lot of that for you on your behalf. You don't ever want to contact the IRS about an assessment. They will walk all over you unless you actually know your rights as a taxpayer. We know your rights as tax advisors because we represent our clients in front of the Internal Revenue Service. So keep that in mind, okay? A couple of really cool smartphone applications that potentially could make your life, your financial life, your financial world a little bit easier, a little bit less stress, or a little bit more stress-free. Mile IQ, great smart device application for tracking the mileage for the deduction. Track My Corp, if you are already incorporated as an LLC, an S Corp, a C corporation, Track My Corp is a reminding application that tells you about upcoming deadlines for your business. I believe that this is the first year that it's been launched, so it still is in beta mode. But over the next year to 2 years, I think that this is really going to be a hot application, especially seeing how many people are starting to incorporate their self-employed businesses. Mint.com, it's not meant to take the place of a bookkeeping service, but Mint.com allows you to link, it's a software program where you link your debit card and your credit card statements, or your debit and credit cards, to Mint. And every time you swipe your card at a gas station, it creates a organized pie chart for you, and it allocates your gas to auto and truck. Every time you swipe your card or buy something on Amazon, it'll sort it to office expense. So it'll organize your information for you. And I believe that the first initial 100 transactions, I think, are free. And then at a certain level, you'll have to pay for additional services. But man, based on how much you'd end up paying a bookkeeper per year, which can be thousands and thousands of dollars, Mint will save you a lot of time, a lot of stress. It'll give you peace of mind that as you're out spending your business money on your debit card or credit cards, that your information is being organized in the background for you. And then when you do your taxes, you just have your accountant log into Mint, print out your annual summary, and then they can prepare your taxes based on this, what's called now a profit and loss statement. It'll show how much income you made, how much you spent, and all of the subcategories broken down for all of your expenses and deductions. So keep that in mind. Great overall smart device applications. I love them. I've been using all three for, Track My Corp only for the past year, but I've used MileIQ and Mint for a very, very long time. So obviously, we've covered a lot today. I know that we had a little bit of hiccup at the beginning, but we are recording this webinar. So if you would like to watch it again, I would suggest reaching out to the Arcadia Association of Realtors. They'll have that readily available for you once it uploads to the cloud. And I also wanted to mention, I mentioned this earlier, Robert Hall and Associates, we offer free consultations. And so I'll give you my contact information in a second. But the main goal with this free consultation is to review prior year tax returns to figure out if there's anything that needs to be changed, to check for possible audit triggers on those individual returns, and seeing if we can actually correct those moving forward to create less of a risk for audit for you. And then we'll also put you on an email update list that lets you know about upcoming free webinars, changes to the Internal Revenue Code. If anything, the information that we send you will help you fall asleep faster at night. The tax code is not exactly the most exciting thing to read about, but man, is it sure important to know if you are a business owner or a real estate investor. Knowing the tax code, not knowing what I know, but knowing enough to just be a little dangerous with the information that you have, it can end up saving you thousands and thousands of dollars in tax. And I always tell my clients that tax savings in my world equates or equals wealth retention. See, why would I want to pay tax rather than retaining that money for my own wealth, right? So proper planning, putting a plan in place will allow you maybe to save $5, $10, $15,000+, let's say, in tax. And in that case, in return, I was able to retain $5, $10, $15,000 of the wealth that I've built myself over the past 12 months. So keep that in mind. Tax savings equals retention of wealth. Just always have that idea in your mind and make sure that you map out a very effective and strategical position for yourself before the end of the calendar year, which is December 31st. Even though it is December 8th, I think today, December 8th or 9th, we still have quite a few days left before the end of the year. So don't think that it's too late to do all of this. Make sure that you get on one of the senior consultants' calendars today by going to roberthalltaxes.com/consult. We can get you in, we can get you the advice that you need. Well, not in, unfortunately, we're doing everything by phone and FaceTime and Skype until the pandemic's over. Then we'll start meeting with people in person. But we will connect with you and get you all of these answers to your very, very important questions. So if you open up the web browser, go to roberthalltaxes.com/consult. That is a great way to get you signed up for the free consultation. I am also going to include my email. If you know for a fact in the chat box, if you know for a fact that you are in need of good year-end consulting, shoot me an email. I'll see what availability I have personally before the end of the year. I've booked up pretty quickly because we are approaching the end of the year. But more importantly, I want to get you into our office for digitally, actually, to get you those answers and make sure that you have a plan in place before the end of the calendar year. So once again, for those of you who are or are watching this pre-recording, I don't know if the chat box will be available. My email is Tony Watson, TonyWatson at roberthalltaxes.com. So Tony Watson, my full name, at Robert Hall Taxes, plural, taxes, TAXES.com. And you just shoot us an email there and we'll go ahead and get you set up with that free consultation. All right, Monica, I'm glad that people are seeing this chat box. So once again, this is going to be pre-recorded for the individuals who are logged in now. Do you have any questions? I'm going to open it up for full-blown Q&A now. If you have any questions that I can answer on the pre-recorded side of things. I know that we covered a lot in this short 45-minute to an hour session. I could tell you right now that there's probably a lot more that we could talk about, but that's why we offer this free consultation. It's to get you, not face-to-face, but talking with one of our senior advisors to make sure that they help you strategize before December 31st. Sure, there are things that we can implement after January 1st, like an IRA deduction, whether it be separate traditional, you could fund an HSA for a greater tax savings benefit. But I'm talking about before December 31st. That's when major tax reduction strategies can be implemented in order to save or retain wealth, save tax or retain wealth for 2020. Once we're past December 31st at midnight, entering into 2021, there are a couple things that we can do, but that's not where the magic happens. The magic really happens in the calendar year through a proper year-end planning consultation. So I did want to make sure that you understand that it's not the end of the world if we don't do it, but there are less strategies that we can implement in the new year versus if we get to talk to you before December 31st. Okay. Well, I know that once again, I know that we started a little late, but I want to make sure that everybody who does eventually watch this webinar, we are readily available to answer any questions that you have. Make sure that you reach out to us. Go to roberthalltaxes.com/consult. Pump in your information there on that web browser. We'll get you set up as quickly as possible for a year-end consultation. And if you are in the market for a new tax preparation firm, if you want to book something for tax season, let's go ahead and get you on the calendar. So contact our office. It's 818-242-4888. Once again, 818-242-4888. Or you can just Google Robert Hall & Associates. Or you can Google tax firm Glendale, California. We're the first firm that pops up. We have 5-star reviews from a number of our clients. We've been around since 1971. So we are going on our 50-year anniversary in 2021. Quite the feat and quite the legacy that the Hall family will leave here in Los Angeles. So thank you so much for tuning in today. Once again, sorry about the little hiccup earlier, but we look forward to discussing your own financial situation with you, and make sure that you stay safe, stay healthy, and we will talk soon. Have a great day, everyone.